Welcome to Module 19. In Module 19, we're going to complete Chapter 9. We're going to be talking about the Statement of Cash Flows. The Statement of Cash Flows is a relatively new statement. In 1987, the FASB asked that all people present a statement of cash flows along with the balance sheet, the income statement, and the other financial statements that a company discloses at the end of each year. The cash flow statement gives you information about where a company got its cash and how it used that cash. In other words, cash receipts and cash payments. Now, when the FASB was determining that a cash flow statement should be included in the annual report, they looked at two different methods of presenting that information. One is called the direct method, and one is called the indirect method. And if you look on your book on pages 331 and 332, you can see that there are examples of each of those methods. The FASB, in theory, prefers the direct method. In the direct method, you show exactly where the money came from and exactly where it was spent. In the indirect method, you start with net income and you adjust net income for changes in current assets, current liabilities, and non-current assets. What you see, if you look at the two different methods that are shown there in your textbook, you can see that adjusting net income is slightly simpler. That's because companies decided it was much easier for them to present the indirect method than the direct method, so you'll find about 90% of firms who publish annual reports actually use the indirect method. We're going to be using the direct method, just touching on it briefly in one of the problems to show you the differences between the two and how they're each calculated. But be aware that in most instances, what you're going to see will be the indirect method of looking at cash flows. Now, if you look over on page 332 of your textbook at the indirect method, you will notice that the company starts with net income, then adjusts it for changes in gains, losses, accounts receivable, and other current assets and current liabilities. The first adjustment that is always made to net income is to add back depreciation and amortization. That's because those are non-cash expenses that have been included on the income statement, but they don't affect the actual cash flow of a firm, so they're added back. The same is true with the other changes. Again, flip back and look at the two methods there that they give you of how a cash flow statement is presented, and you notice that the investing and financing sections are the ones that are the same. The only change will be in how the operating section is presented. In talking about the investing and financing sections, let's look first at the investing section. In the investing section of the cash flow statement, the firm discloses their purchases and sales of non-current assets, such things as land that they bought, buildings they bought and sold, equipment that they bought and sold. They also include such things as financial investments, which would be stocks and bonds, that they purchased in other companies that they're using as investments. So you will see mainly non-current assets and other investments in the investing section. It's fairly straightforward. The third section is called the financing section of the cash flow statement, and it's exactly what it sounds like. Where did the company get the financing for their activities? Well, they get them through what we call non-current liabilities. And remember what non-current liabilities are. They're liabilities that are due more than a year from now. Those would be things like long-term notes payable and bonds payable. It also discloses any way that they got cash through the owner's equity account, for example, selling stock, buying back stock. Any dividends that they paid would also show up here. So I think you can see that the investing and financing sections are fairly simple. The complicated part of the cash flow statement is in the operating section. But that's really the key section for most companies because that tells an investor and a creditor and management where the cash is coming from, where it's going, and whether they are actually making cash, having an inflow of cash from the regular operations. Most companies go bankrupt in the first 5 years not because they're losing money, but because they don't have the sufficient cash to keep the company in business. So cash flow is an integral part of managing a company. When you look at the statement of cash flows as an investor and creditor, look at those three categories. Did the operating section provide enough cash for the company to continue in business. What did they do with their other monies? What did they invest in? What did they sell? Where did they get their financing? Did their cash increase or decrease? And again, you might want to look for trends. Did their cash continually decrease over a number of years? Did their cash continually increase? How is their cash management system appearing to be effective? So it's a very useful tool for investors and creditors because remember, investors and creditors get their returns on their investments through cash payments of dividends and interest. So it's in their interest to be able to see if there's any cash available for those payments. Well, let's look a little bit at some examples of the cash flow statement. And let's use exercise 9.11 in your textbook as our first example. That's on page 342, about the middle of the book. And it's talking about cash flows. And the first one they ask you, sales on account, all are collectible, amounted to $760. And accounts receivable decreased by $24,000. How much cash did they collect from their customers? This is a section that would show up in the direct method of the cash flow statement. And you have to understand that if sales are made on account, that means that you're going to debit your accounts receivable, you're going to credit your sales. As you collect those accounts receivable, you're going to debit cash and credit accounts receivable. So your sales may not be the same as your accounts receivable. So what you have to do is take your sales number and adjust it for any changes in accounts receivable in order to determine how much cash you actually got. Well, in this case, your accounts receivable went down, which means you collected more accounts receivable than you put in. So that would be in addition to your cash sales. So you would have $760 in cash plus $24,000 in the decrease of accounts receivable. So the total cash you collected from your customers would be $784,000. Using that same idea in Part B, income tax expense for the year was $148,000. Income taxes payable decreased by $34,000. How much cash did they actually pay for taxes? Well, if their income tax expense was $148,000, their income taxes payable went down, that means they paid more, which means they paid additional cash over and above the $148,000. So they paid in cash $182,000. In Part C, it says that cost of goods sold amounted to $408,000. Accounts payable increased by $19,000 and inventories increased by $14,000. So how much cash did they actually pay their suppliers? Now think back to our early discussion of what cost of goods sold involves. It involves purchasing merchandise, so that's going to be your inventory, and you typically purchase that merchandise on account, which means that you charge it. You're going to pay it later. So there are going to be two effects on your cost of goods sold. One would be the decrease or increase in your inventory account. The other would be your decrease or increase in accounts payable. So you start with cost of goods sold, and since your inventory went up, you added cost to your cost of goods sold, so you're going to add the increase in inventory. However, your accounts payable also increased. So that means you charged more than you paid, so you will deduct that because you're looking at cash. You charged more than you paid in cash, so you'll subtract that. So the cash paid to your suppliers then is the $408 of cost of goods sold, plus the $14,000 increase in inventory, less the $19,000 increase in accounts payable. That gives you $403,000 that you actually paid in cash to your suppliers. Finally, in Part D, it says the net book value of your buildings increased by $240,000. No buildings were sold. Depreciation expense for the year was $190,000. How much cash did you pay for the building? Well, you're going to look at the increase in net book value, which is the increase in your assets. You will add to that your depreciation expense because, again, this is a non-cash deduction. So you add those two together, and that will tell you what you paid for the building. So you take $240,000 and add $190,000 to it. That means that you paid $430,000 for the building. Let's look at a fairly real-world example. Let's look at exercise 14, which is near the top of page 343 of your book. And in this exercise, we're going to be looking at Intel's annual report. So you may want to flip over to page 635 and mark it for future reference, because that's where we're going to get the data that we need to answer the questions here in exercise 14. For example, in part A, it says identify the 4 most significant sources of cash from operating activities. Well, if you look over on page 635 of your textbook, the first part of the cash flow statement tells you where the cash came from. You can see that if you look down through those numbers, the biggest numbers under the operating activities for 2001 would be amortization of goodwill. You see that one? Additions to property, plant, and equipment. Purchase of available for sale securities. So you can look at a lot of those and see all the different things that happened. In part B, what were the firm's investing activities? That's the slide that's on the screen now. You can see that they bought property, plant, and equipment. They bought available for sale securities. And they cashed in some of their available for sale securities. That's where you get the plus $15 million. So you can tell they used $195 million of the cash that was generated by operating activities in their investing activities. Finally, it asks you the 2 most significant financing activities. 2 most significant financing activities, you look at the bottom down there. The $762 million would be the proceeds from sales of shares through employee stock option plans, and the $306 million additions to long-term debt. Additionally, you also paid dividends to your shareholders. You see that, of $538 million, and you repurchased and retired 4,000, which would be like $4 billion worth of common stock. So that's a real-world example in exercise 14, where you get to go through and look at Intel's cash flow statement. Realize those numbers are in millions of dollars. So I think you can see how important cash is to a company. Finally, in problem 21, which is about the middle of page 345 of your textbook, they ask you to look at some information that's in the middle of the page there and then calculate net cash flow provided by operations. In order to do net cash flow provided by operations, you'll want to refer back to your textbook and look at some of the examples. Realize that you start with net income, you add back your depreciation expense, and then you look at changes in your current assets. For example, accounts receivable, your inventory. Then you look at changes in your current liabilities like accounts payable and income taxes payable. And you should come up with cash provided by operating activities of $790. In part B, they ask you to explain why net income is different from net cash provided by operating activities. Remember, net income is accrual accounting. You can earn revenue before or after you show it as cash received, and expenses can show up as expenses on your accrual accounting before or after you actually pay them in cash. So accrual accounting will be different from cash accounting. In this section, what I would spend some time looking over would be the operating section of the cash flow statement, looking at the 2 different methods, the direct and the indirect method, and making sure that you understand the differences and how each is computed. We will continue with Chapter 10 in the next module.